mentioned is kind of now a sweet spot in the lower, quote unquote, middle markets. However, how about a family that's really big, $10 billion or more, that's not going to move their needle, or the so-called consortiums? I've heard of stories of 5 or 10 families around the world banding together, forming an entity, and basically having liquid, like $1 billion, $2 billion, $3 billion ready to go. They're going to need a deal that has a little bit of juice and scale to it, but aren't they competing against the big boys in terms of the professional shops as well?
So I think the answer is yes. Once you start getting to that size, you likely are starting to bump up against the big boys, and I think the returns when they're trying to deploy that type of capital go down. Just like you see that in general, larger private equity firms have lower returns than some of the lower middle market ones. That said, I think the shrewd families take a step back and say, what is my comparative advantage, right? What can I do that private equity can't? And so there's certain industries, for example, that private equity can't get approval. So for example, dealerships is one space. A lot of franchises is another, where the parent basically has approval, the right to approve, and they won't approve private equity. I think there's also some geographies where there's not necessarily efficiency. So particularly families that are comfortable with the emerging markets, there often are some inefficient opportunities that only they can invest in, particularly because there's not necessarily an exit environment. And so private equity is not comfortable entering into those markets. Right. And then finally, I think most importantly, I think you need those families often are deploying their capital in more growth capital investment structures. What I mean by that is, if you're doing a complete buyout and you're buying 100% of a company, you're basically, the business owner is going to say, well, I don't really care who you are. You could be my best friend. I'm going to sell to whoever's the best price, more or less. It's about price. But if you're basically raising growth capital, if you're selling a portion of your business, you're basically taking on a partner. That's a marriage for a pretty significant amount of time. And there I feel that families have a strong comparative advantage relative to a faceless fund, in that the business owner that's considering them is going to ask questions like, who do I trust? Who is going to be supportive and not be second guessing me and be a pain in my side? Who can add value? And that's really, I think, the space that you see consistently where some of these big consortiums have been very effective. For example, if you look at BDT, which technically is a fund structure, but is just with families, you'll see that they pretty much exclusively are investing in minority growth capital investments, minority recapitalizations. There might be some majority, but in general, they're not participating in complete buyouts, because then it's just kind of a shooting match to see who can pay the most. And that's just really not, the cost of capital of some of these private equity firms is so low, and their principals, quite frankly, have an incentive to deploy capital. So on the margin, they're going to overpay, relative to a family that thinks about investing more as an owner, as opposed to, thinking about it as somebody else's money.